Welcome back to Daily Wall Street. Today is Wednesday, March 26, 2025, and we're diving into a big question. Is the AI boom entering bubble territory? And why is Tesla still surging despite a 40% sales drop in Europe? Markets continued to rebound yesterday, with the S&P 500 rising for the third straight day, its best streak since early February. But semiconductor stocks lagged behind, with the Philadelphia Semiconductor Index down 0.7%. Investor optimism is being tested by uneven sector performance. Weak economic data is adding to the tension. The latest Philly Fed Services Index dropped to 17.5 in March, with new orders plunging to 19.5, both multi-year lows. Employment conditions worsened as well. The full-time jobs index turned negative for the first time in 7 months, and price pressures rose. Meanwhile, U.S. consumer confidence dropped for the fourth consecutive month to 92.9, with future expectations crashing to 65.2, deep below the recession warning level of 80. Only 37% of consumers now expect stocks to rise in the next 12 months, down from 47% in February. Bearish sentiment is quietly climbing. In response to economic weakness, Treasury yields slipped slightly. The 2-year yield fell to 4.02%, while the 10-year dropped to 4.32%. Bond ETFs like IEF, BND, and AGG posted mild gains. Investors are shifting towards safer, duration-balanced government and aggregate bonds. High-yield bonds remain too risky for defensive allocation. Their equity-like behavior makes them vulnerable during downturns. Let's shift to AI and tech. Apple gained 1.4% yesterday on news it ordered $1 billion worth of Nvidia's GB200 NVL72 GPUs for future AI projects. Apple is signaling a shift in strategy by investing in compute infrastructure. But the June 9th WWDC may not center on AI, according to Bloomberg. Meanwhile, Nvidia stock actually dipped 0.6%. The absence of new AI catalysts and renewed trade worries weighed on sentiment. The Biden-era AI export rules, set to take effect on May 15th, are stirring controversy. The policy classifies countries into 3 tiers of chip access. Tier 1 allies like Japan and the EU enjoy full access. Tier 2 countries, including India and UAE, face usage limits. Tier 3 nations like China are completely banned. Tech giants like Nvidia and Oracle are pushing to ease the restrictions. Oracle has billions invested in data centers across Southeast Asia and the Middle East, but Washington isn't backing down. The strategy is to centralize AI compute power within U.S. borders and among select allies. According to SEMI, global compute power is rapidly consolidating. The U.S. controls a disproportionate share, while most of the world falls behind. This asymmetry is fueling a new form of digital geopolitics, where AI infrastructure is the currency of global power. But is this AI boom sustainable? Alibaba chairman Joe Tsai thinks otherwise. He warned of an AI data center bubble forming in the U.S. Tsai said, "Many projects are being built without confirmed customer demand. The race to invest has outpaced actual use cases. Chinese firms are responding with leaner strategies." Ant Group now trains AI models using domestic chips, claiming cost savings of 20%. Other companies are open-sourcing models to reduce dependence on Nvidia's top-tier GPUs, betting on wider ecosystem collaboration. Despite this, Hong Kong's tech stocks took a beating. Alibaba dropped 4%, Xiaomi 6%, and the Hang Seng Tech Index entered a correction, which brings us to Tesla. Its February sales in Europe crashed 40% year-over-year, and total YTD sales are down 43%. This contrasts with Europe's 26% EV growth and declining ICE car sales, signaling a loss of market share for Tesla. Production halts, model refreshes, and backlash against Musk's political statements have hurt European performance. Still, Tesla stock surged 3.5% yesterday and is now above its 200-day moving average. Is this another short squeeze? Cathie Wood's ARK fund maintains a $2,600 price target for Tesla, driven by expectations of robotaxi dominance. ARK believes autonomous driving will represent 90% of Tesla's value, far outpacing any traditional. EV competitors like BYD Tesla bulls are buying a future of integrated energy, AI, autonomy, and scale. The market is betting on that long-term vision. But this vision comes with risk. Valuations may overshoot fundamentals in the short term, especially with slowing growth abroad. As always, consider your position size, time horizon, and conviction. Tesla isn't just a car company. It's a volatility play with upside optionality. Thanks for watching Daily Wall Street. Don't forget to like, subscribe, and ring the bell. We'll be back tomorrow with more.